All righty, class. Welcome to week 6. All right, so just like everything else, going to the course content, looking at reading 6. You got your chapter 10 reading, presentations, and videos. And then we go to the learning activities and assessments. And here you'll be writing a discussion board for the accelerated depreciation method, trying to give an example of when that might be used and for what type of company. And then you have your Learn Smart assignment and your homework assignment. So this week is about depreciation. I wanted to go ahead and create 2 slides to help you in your studies. So I'd go ahead and make these into flashcards for yourself. So with depreciation, I want you to understand that all of this is using the accrual base, because in cash, as soon as the cash trades hands, then the entire amount will be expensed. So when we talk about depreciation, we're talking about the accrual method. With depreciation, the goal of the depreciation is to match the use of the asset to the time that asset generated revenue. So the biggest asset that we're going to be talking about is a building. So for a company that goes and purchases a new building to house their operations, they're going to be using that building for quite a few years. And so the amount that they spend on that building has to be expensed some way over the life of that asset. So the easiest and simple method is the straight line method. You just do an equal depreciation expense each month up until the time that you're no longer using that asset. That works good for buildings or things. There's other assets that are based off of the usage. So you have more factory equipment and these type of items that as they produce a certain amount of widgets, we're going to depreciate the expense equally over the amount of widgets that it produces. And then for certain assets, and if you notice that when you go out and purchase an asset, go out and purchase anything from the store or your Christmas presents, if you realize that when you first get that, you're going to be using it a lot more often than as it gets older. So with factory equipment, that when it's brand new on the line, it's going to be spitting out those widgets a lot quicker than after, say, 3 or 4 years, whenever it's only doing half as good as it did. So because of that, we find ways of increasing the expense earlier on. And so there's the double declining method. And we'll get into the calculations of each of these during our homework. So with that, the relevant accounts that we're going to be using on this, so you have your, what we call PP&E. It's your property, plant, and equipment. We're going to keep a separate category for each type of asset, but we will lump it together just for easy disclosure. We're going to keep separate, but it's still a contra asset. So it's still under here in the asset line, but it is a contra asset, and that's the accumulated depreciation. So with that in mind, when we increase the PP&E, that's going to be a debit to increase the asset. When we increase the depreciation, that's going to be a credit because it's increasing the contra asset. At the same time, we're also going to be impacting equity over here, because within equity we have net income, and under net income we have our expenses, and this is the depreciation expense. It's important to note here that as your depreciation expense increases, your net income decreases. And so because of that, the double declining method and these type of methods that accelerate that depreciation is going to have a benefit in taxes, because you're going to depreciate more up front. So your net income earlier on is going to be lower. And once again, a lower net income creates lower taxable income, creating lower taxes. So it's important to note that, again, we have what is a pure estimation. We had to come up with some way of matching up the expenses to the revenue. And because of that, we have different ways of doing this. It's going to have a different cash impact. So once again, accountants are coming to the board to actually create a benefit for the company. Another slide I want you to work on is just some general notes here. So you'll hear historic value. So that's the purchase price that we maintain that asset at. So again, we're going to increase the PP&E with the debit. Whatever we purchase the price for, that's going to remain there. And we're going to separately have that accumulated depreciation. We also have what's called a residual or salvage value. So what that means is when we first purchase the asset, we have to go ahead and think about how long are we going to keep the asset for. That's the useful life here. And at the end of that term, if we're going to turn around and sell it, then we need to account for the fact that there's going to be some value still left in there. Okay? And that value we call the net book value. At any given point, it's the historic value, that debit that we created, less the accumulated depreciation. So however much depreciation expense we've come up with at that point. The net book value is important because when we go and sell that asset, whatever we sell that asset for, we're going to compare against what we have as the net book value. And that's going to be our gain or loss. And we'll get into what the entries look like for a gain or loss. Another term you'll see is the depreciation rate. So to remember that formula, it's 1 over the useful life. And when we're talking about a double declining method, we're just going to multiply that by 2. Now remember, while we're going through that depreciation, no time can the PPE minus the accumulated depreciation be less than the salvage value. Because if we've estimated that this is how much we're going to sell it for, then we have to maintain, we can depreciate it up until that net book value. So when we do the double declining method, when we do the usage values, we got to figure out a way to get that salvage value in there. Okay. With that in mind, let's get into our homework. All right, so here we're looking at the journal entries for each of these assets. So we have a mill that cost us $125,500. At this point, we have accumulated depreciation of $92,800. We want to prepare the entries to record the disposal. Okay, so we're getting rid of this. The machine needed extensive repairs and it was not worth repairing. So we disposed of the machine, receiving nothing. So at this point in time, we have to remove the 125. So this is an asset that we're getting rid of. So to decrease the asset, we're going to credit it for the 125. At that point, we're going to need to wipe out the accumulated depreciation that we have. So accumulated depreciation is a credit. That means we need to debit it for that amount. All of our journals need to balance. And here our sell price is 0. And we just calculated what the net book value is by saying this is what we purchased it for. This is what the accumulated value is. And so we're going to have a loss here. A loss is an expense. And so to increase that expense, we're debiting it. So that's the loss. In the second version, we sold it for $16,100. Okay. Same entries for the debits and the credits on the actual value. Here we have a debit of cash of $16,100. And once again, we need to balance the entry. So the residual is the loss. Just so happened on the third round, we got the exact amount of cash. So there is no gain or loss. We're balancing this entry strictly by debiting the cash. Again, cash is an asset. When we get that cash, we're increasing it. That's a debit. And then in the fourth case, we sold it for above the asking price. So again, we're debiting cash for the same amount. The accumulated depreciation and the machine itself get the same entry as in all the other entries. And to balance this entry out, we have to credit for $8,000. Okay. And again, that's using the same formula that the gain or loss is the cash received minus the net book value. If it's positive, that's a gain. Gains are recorded as a credit. If it's negative, that's a loss. Losses are recorded as a debit. The easy way to remember that is to balance your journals. Debits have to equal credits. All right, here they're actually calculating the depreciation. So we had a cost of this amount. The estimated useful life. See, it's 5. Yep, 5 years. And so we also have a residual value here of 2,000. So when we take the straight line depreciation, we'll take the cost minus that residual value, because we're not going to depreciate less than the residual. That amount gets us the cost minus salvage. We divide that by the useful life, and that gets us our annual depreciation expense. Every year for those 5 years, we'll expense this amount. Here we have another disposal. Not going to go through these. It's the same calculation and same entries, just different amounts. So it's giving you that repetition of making that calculation. All right, here we're assigning cost, because some items we will be able to add to the value of the PP&E, and some we're going to have to expense right away. The general rule is that if the item increases the useful life, then we're going to add it to the value, and we're going to depreciate it using the method that we depreciate. If it doesn't, or if it's a routine maintenance item, we're going to expense that immediately, because that's only, you're going to have that expense each period. Okay, so when we're talking about removing and disposing old equipment being replaced, this relates to the old equipment. So that's going to be in that gain or loss value. We're going to expense that right away, because again, we're disposing of the equipment, so the cost related to that no longer has a value to us. It doesn't increase the useful life of this equipment. We just got rid of it. So that's going to be an expense. The cost of the crew to unpack the new, so we wouldn't be able to use the new one if they didn't unpack it, so we can add that to the value. And think of just like the inventory, anything that gets that inventory to the sale floor, we're going to add to. Construction costs for new building being used in operations. Again, new building, whether we buy it or we build it, all of that goes into the value of the building, so we're going to capitalize. Freight costs from manufacturer to the warehouse. Again, just like the inventory, anything that gets it to the floor, we're going to add to it. Purchase land, add to it. Now we're training the employees. So training is always going to be expense at the time the training is performed, because you're taking your time out at that point. Now, yes, there's future value of it, but there's also probably going to be future training involved. So we're just going to expense the training at that point, because it's really, we're not going to be able to quantify the value of that future training. So it's easier to expense. Brokerage fees incurred, so that goes into the purchase price of an asset. So we're going to capitalize that. And if we're building anything that's increasing the value, we're going to add to it. Okay, those are good hints. All right, so now the entry to actually do the depreciation. So we'll go through the calculation here, because they don't have it spelled out. And open up the Excel file. All right, so when we're doing depreciation, we're always going to need the purchase price. All right, so we had that value, 3958920. We installed the machinery, so we're going to add 1,676,900 to that. Here we're using okay. So we're going to keep these two things separate. Here, we're going to sell 158,400 tons. Oh no, we're going to be able to do one total of 1,414 tons. And in this period, we have used 158,400. Formatting, make it look pretty. Extra zero somewhere. 3958. No 6 there. 443,489, 19,817. So the way to do that again is the purchase price, and we're using the usage method. So take the purchase price divided by the total usage to get a per usage. And then this is the period usage. That you're going to multiply it by. And that's going to get you your period depreciation. And again, what this helps is that for those factories that you're going to use more at the earlier stage, this lets you evenly match up each unit you produce to the expense. Okay, so we know over the life we're going to be able to pop out this many widgets. This period we popped out this many. So you multiply those rates together to get your expense. We're increasing our expense, so that's going to be your debits. And we're increasing the contra asset, so that's going to be the credits. And again, we're going to keep the machinery and the mineral itself, the land, two separate accounts. All right, so this goes into just the purchasing of it. We're increasing each of these assets, so that's going to increase the debit. We're spending money for these assets, so that's going to decrease the asset with the credit. We've gone through how to calculate and the entries. Now, again, on the depreciation expense, notice we're using the contra asset here to increase that credit. The net book value will go down because of this, because you're crediting with something that's in the asset account, but we're keeping those accounts separate. All right, and then straight line, we'll take that historic value minus any salvage value divided by the useful life. And so you saw that formula on the first ones. So again, just repetition on those. All right, here, cost of 66, useful for 5 years. We think we're going to sell it for 2,000. Okay, so here what's happening is we've started using the depreciation based off the assumptions that we had a 5-year useful life. Once we've gotten through, we're actually going to revise that estimate. So what we do when we revise the estimates is we basically just say, okay, everything we've done so far is okay, but based off of today, we're going to redo that value, okay? So we're going to need to calculate how much depreciation did we do from this period that we purchased it to the point that we realized those assumptions were wrong. Okay, so we had 1 year of depreciation, we had the salvage value, and that gets us the remaining depreciable costs. Okay, and then we're going to use this and start over, saying that at this point, we're only going to be able to use it for 2 more years. So the depreciation at that point is going to be this value divided by 2. So again, we're saying everything up until this point is okay. We're not going to go back and restate prior year. But from this point on, with the new assumptions, we have to update our calculation. All right, so again, this is just units of production. Take the total value, less any salvage. That gets you your total cost. Then we're going to divide by the total units of production. And that gets you a depreciation per concert. We multiply by the number of concerts, and that gets you your depreciation expense. So just repeating these calculations. All right. Here we're going to use straight line, and then we're also going to be using the units of production. So in each of these, the cost minus salvage is going to be the same. The difference is the base, what you divide by here, is going to be the useful life. That gets you your depreciation expense. You're going to use that each year, and the net book value is going to be the purchase price minus those 2 years of depreciation. Units of production is the same thing, except the base is the total units we can produce, multiplied by the units that were produced that period. That gets you your annual depreciation expense, that period's depreciation. And finally, the last one, we're going to use all three methods here to go through those calculations again, and they want you to calculate the depreciation for each year. So straight line, no surprise, when you do that calculation, it's straight each month, each period. Here in the years, we use the depreciable units multiplied by the depreciation per unit. And you can see here it's almost the same, but does vary based off of how much use you got that period. Double declining, we're going to use that depreciation rate. And again, it's going to be multiplied by 2. And you take that rate multiplied by the book value at the beginning of the period. Now realize I said book value, not net book value. Okay, so we don't want to worry about the salvage value at this point. So it's going to be just the purchase price we start with, multiplied by that depreciation rate. And you see each period you're using that. Except again, we can never go less than what our salvage value is. So if we ever get to that point, we're going to cut the depreciation off at that moment, and we're only going to depreciate that expense. Okay. Good luck on y'all's homework, and I will see y'all for week 7. Getting there. Y'all have a good one.